one and all. My name is Sahil Mahimkar, current second year Electronics and Computer Science student at FRCRC. I also serve as the Junior Data and Tech Head at Student Alumni Committee of FRCRC, and I shall be your host for this webinar. Before we begin with our speaker, I would like to introduce to you the Student Alumni Committee of FRCRC and give you a little detail about the event and what is in store throughout. The Student Alumni Committee was formed as a body under the umbrella of the Alumni Association of FRCRC to better coordinate with CRC alums across the world and to showcase the incredible achievements in the multitude of fields. The Alumni Association of FRCRC is made up of our dynamic alums and the alums who are faculty members of the college, with the objective being to serve as a bridge between the existing students and the thousands of alumni world over. We wish to do this by organizing interactive sessions, webinars, and connecting our existing students to the talents of our alumni so that they may benefit from these experiences. Moving on to the webinar, where we have our very own experienced alumni as the speaker, the discussion will revolve around our main topic for this event, which is about goal-based financial planning and how to effectively invest. He will be covering few important points like strategies to save and manage debt effectively, some of the typical mistakes that investors make, basic approach that will allow investors to achieve their financial goals. There will be a brief discussion on the current state of the financial markets, like the stock market, and right strategies to manage the volatility in the markets. I am personally thrilled to be here because, like all of you in the audience, I too am curious about this topic and would love to learn and gain some clarity on how to go about investing. Now, I would like to introduce our speaker for the event, Mr. Girish Ajgaonkar. He is a graduate of a Silver Jubilee batch of 1995 Electronic Engineering. After graduating at FRCRCE, Mr. Girish pursued MBA from the Tuck School Business, Dartmouth College in United States. He is currently the Chief Revenue Officer at Happiness Factory. Mr. Girish is a seasoned business leader with the extensive experience in financial services across the US and India. His expertise includes managing large profit and loss for Fortune 500 companies and advising C-suite executives on revenue maximization and cost reduction initiatives. Outside of work, Girish is also a volunteer teacher with the Art of Living Foundation. Thank you, sir, for taking the time out and being a part of this event. Before getting started with the discussion, I would like to request the audience to please mute yourselves and switch off your camera. Thank you. Sir, you can start.
My pleasure. And thank you, Sahil, for that introduction. And I'll just request one thing for everyone. If you can, if your bandwidth permits, please turn on your videos so that I don't get the feeling that I'm speaking to like blank squares on the screen, right? If you can. So with that, let's get started. First off, thank you so much for giving me the opportunity. I conduct a lot of these sessions, but this session is special to me because as Sahil said, I have a long association with CRCE, right? And so thank you again. I'll talk a little bit about who we are, Happiness Factory, and what we do. Happiness Factory is a goal-based investing platform. And our objective is very simple, to help our clients achieve their goals. Right? It's not so much about products, it's not so much about stocks, but it's about investors' goals. Right? That's our philosophy. And our story actually started way back in 2004 when our founder, Amar Pandit, who coincidentally also my batchmate from Father CRC, 95 batch, right? Both Amar and I were 95 electronics batchmates. So Amar started his wealth management firm in 2004 called My Financial Advisor, right? And Amar championed this philosophy of goal-based investing. And then fast forward to now, from 2004, My Financial Advisor ended up focusing on high net worth individuals. And with this desire to take the same goal-based investing philosophy to everyone, Amar launched Happiness Factory. So that's our story. I am the Chief Revenue Officer at Happiness Factory, as Sahil already said. So that's a little bit about who we are and what we do. Let me bring up my slides. Got a brief presentation for you, and we'll take all the question and answers towards the end of the session. Okay, so please hold on to all those questions till then. Are you all able to see my screen?
Yes, Girish.
Okay, wonderful. So here is what we're going to do today. We've got about another 40, 50 odd minutes. Before we jump in the goal-based investing, we're going to talk about prerequisites for investing, right? Because investing is a long-term game, and you are going to be able to play that long-term game if you're able to manage your short-term, right? And many of you I see over here, many of you are young. I see, especially the alumni team. You're in your second year, first year, third year, whatever, in your college. So this is important, right? So prerequisites for investing, even before we can invest, there are a few things that we must absolutely do. That's number one. We're going to talk about that. We will also talk about how typically the investment decisions are made today, right? And then we're going to go into how should they be made, right? What should drive our investment decisions. So there is a wrong way of thinking about investing, and also there is a right way of thinking about investing, which is what we're going to do. We're going to discuss all of that. Then we're going to go into goal-based investing, right? This is where I'm going to touch upon the important ideas and important concepts of goal-based investing. And then I want to end this session with something, as I call it, principles of wealth creation. Right? How do you systematically access the equity markets and then thereby create significant wealth for yourself? Right? We're going to talk about that. And on this point, we'll also talk about the current market and where the numbers are and so on, and how should we be thinking about the market. I'm just going to pause a little bit on this screen for compliance reasons. Durlabh, you let me know when you're all set.
Yes, Girish, we can start.
Excellent. So let's talk about the prerequisites of investing, right? As I said, investing is a long-term game. So first, you have to be prepared to tackle your short term. How do you tackle your short term? So this is a classic statement from Warren Buffett that says, let me back up a little bit. Tackling your short term is what being able to save your money, right? If you can't save your money, there is no way you can invest. So let's talk about saving first. And Warren Buffett has this classic quote that says that do not save what is left after spending, but spend what is left after saving. It's a very simple yet very profound quote, and we don't often adhere to this. So this is how most people typically save, right? We get our salary or whatever income we get, then we start actually allocating that salary to various expenses. Okay, this much of my salary is going to go to rent, EMI, house EMI, whatever it is. This much of the salary is going to go to groceries, travel, and so on. And then we say, okay, I've taken care of all my expenses. I'm left with this much. Now that's going to be my saving, right? Seems like a logical way to do it, but it's the wrong way to do it. You should first think about how much you want to save, take out that from your salary, and then manage your expenses in the rest. So it's about setting a saving goal for yourself and a concept of paying yourself first. By saving first and then spending, you're actually setting some money aside for your future self, right? This is extremely important. I've had investors who come to us and tell us, look, I'm earning in crores, 2 crores, 3 crores annually, but I'm still not able to save. It is because they're not following this approach. So always save first, then spend, right? Review all major purchases from the lens of liquidity and debt burden. In the context of what we're surrounded by today, the uncertainty that looms large, ensuring enough liquidity is extremely important. And managing your debt burden in that context is extremely important. You don't want to get stuck in loans, right? Or debt. So we will talk a little more about this further down the line. Maintain immediate liquidity, given the uncertainty that surrounds us. In any case, even if this was not the situation, I would always tell people to maintain at least 6 to 9 months of money that you can actually fall back on at a short notice, right? In case of any unexpected expenses, in case of any unexpected events such as job loss and so on, right? So keep that as a safety net. And the most important thing, arguably the most important thing, is start saving today. It's never too early or it's never too late to start. The important thing is to start saving and investing today. Even if you can set aside, let's say, 1,000 rupees, 2,000 rupees, whatever it is per month, harness the power of compounding. I'm going to talk about that also a little bit. So once you've taken care of these four things, in a consistent manner, on a timely manner over a period of time, then you're ready for investing, right? So that's the prerequisites for investing. So now let's go to the second one. How do we typically make investment decisions? And this is based on what we've seen in the marketplace. This is based on what I have experienced personally when I speak with investors and so on, right? So this is a wrong way of investing, by the way. So number one, the biggest challenge that we all have is that many of our investment decisions are taken without complete clarity on how much money do we really need, right? So there is this huge gap of perception of how much money we need and the reality of it. Now, let me give you an example. If you want to buy a car, for example, in another 6 months, you fairly accurately know how much money it's going to cost you, right? You can visit a dealership, you can do some online research, and it will give you a fairly good idea as to how much money you need, even if you want to buy it in 6 months. But if I ask you a question, do you know how much money you need to live a happy retired life? And if you are, let's say, in your 30s, it's going to be very hard for you to be able to answer that question. Typically, right? There may be some of you who have that absolute clarity, more power to you. But typically, people find it hard to answer that question. Why? Because we are looking at a long-term goal. If I'm 30 right now, I'm looking at another 30 years before I retire, and I'm trying to project how much money I need after my retirement for another 25 years. So I'm looking at 60 to 85 years of my age when I'm at 30. People can't often do that. We are just myopic. We have a great way of looking at our short-term needs, but we have very hard time of projecting our long-term needs because inflation trips us over, right? So typically when we are thinking about our future, very long future financial needs, our perception of what we need is significantly smaller than the reality. Right? That is the first thing we need to keep in mind. So always get the clarity. Second thing, most people make investment decisions that are led by products. We are surrounded by news cycles, 7x24 news cycle. We keep hearing about all these IPOs. There is an IPO boom right now. Right? We keep hearing about different names. We keep hearing about different stocks, different mutual funds. People say, oh, this mutual fund has given X% return last year. This one has given Y%. I want to invest in that. Most of our investing decisions are driven by product, unfortunately, right? We hear people say something, oh, I've made this much money in this stock. Okay, so let me also put some money. We hear some publication that say this is a top 10 list of all-time high stocks, right? Let me invest some money in this. Something to keep in mind, we are not a collector of assets. We are investors, right? And investors should not actually take an approach of or let their decisions be driven by products or in an ad hoc manner. That is the second mistake that we've seen people make. And the third big mistake is we let our investment decisions guided by our emotions. What are those emotions? Fear, greed, panic. Yeah. So there is this concept of timing the market that I want to elaborate a little bit on this. And we all have seen over the last year or so, starting from the dip of March 23rd or 24th in the financial markets when the markets crashed to now, right? The market has done a zigzag movement. It is never a straight line. There is a lot of volatility in the market. The market has gone up, gone down. And most people do not react to these swings, people who are already invested in the market. But the behavior that we see is as follows, as I've shown on the graph, right? When the market is going up, everyone's really happy. We're in the bull market, right? Everyone's happy. My portfolio is going up. People are talking about their stories of how much money they've made in the stock market and so on. And so people want to get in when the market is on the swing. So a lot of people tend to invest when they hear all these stories, right? When the market starts falling down or crashing, People get afraid because they see their portfolios going down 10%, 15% day after day. They're like, okay, I want to get out of the market because I want to cut my losses, right? So they sell. So buying out of greed and selling out of fear is a typical investor behavior that we see. The other word for this is trying to time the market. We are trying to actually time the market so as to cut our losses, or so as to maximize our gains, right? If you think about it logically, this is the exact opposite behavior that you should be demonstrating. When the market is expensive and the market is rising, you should be holding on. And when the market is at its low, you should be buying because you're buying more of that market for the same amount of money, right? But people don't do that. So this is called timing the market. A very big mistake that investors make. So on the backdrop of these three mistakes, I want to leave you with a quote from this pioneer, Benjamin Graham. Benjamin Graham, for those of you who don't know, he's the pioneer of something called value investing, right? And Warren Buffett actually quotes Benjamin Graham. And the quote is very powerful. The greatest danger investors face is acquiring speculative habits without realizing they have done so. What is a speculative habit? The behavior that I just talked about on the last three screens, right? Buying when the market is high, selling when the market is low. That's all speculation. We're trying to time the market. They then end up with a speculator's return, not a wise move for someone's life savings. You have to keep one thing in mind when we talk about investing. Investing is not about short-term trading. Investing is not about looking at a specific stock, putting some money with a desire to pull that money out in a month from now, assuming that the market is going to go up. That's not investing. That's speculation. That's trading, right? This is the most important thing. Speculation is different from investing. We are here, I'm going to talk about investing. We are not here to speculate our hard-earned money, right? Now, there are these 7 deadly scenes, as I call it, that we've seen in our investor base. I'm going to lay out some of those things one by one. Too many expenses and loans, right? As I said, before you can invest, you have to be able to save. And if you have too many expenses and loans, you're not going to be able to save. Again, there are certain loans that are extremely expensive. Credit card loans, personal loans. You may not even realize, but we typically pay about an APY or annual percentage yield about 40% plus in India on a credit card loans. Extremely expensive. No investment is going to be able to give you 40% return. So if you have those type of loans, please clear them off before you think about investing, right? Now there is, again, within this loans, there is a good loan or a good debt and a bad debt. What is a good debt? Let's say spending money on your education, right? That is a good debt. Why? Because it's adding value to you. So it's bringing an asset to you. With that asset over time is going to enhance, it's going to bring more and more value to you. That's a good debt. Buying a house at the right price point in the right location is a good debt, and taking loans for that is a good loan, right? Provided we make all the property decision the right way. What is a bad loan or a bad debt? Taking some loans, significant loans, to buy that top class vehicle, Ferrari or whatever, right? It's a bad loan. Why? Because the moment you drive out of the dealership with that vehicle, your asset value is already depreciated. That loan in the long term is not going to give you anything, right? So be very clear, a good loan and a bad loan. And manage your expenses the way I talked about. First save, then whatever that's left with, manage your expenses. Over concentration in real estate, right? It's great when we feel or when we know that we own a property, right? It's something tangible that we own. Nothing wrong with that. Do not load up on real estate, right? Because real estate, as you have to be, before you buy any real estate, there are a few things that you need to keep in mind. Are you buying that real estate as an investment, or are you buying that real estate to live, right? There are separate considerations for it. If you're buying that as an investment, you have to keep in mind, what price point are you buying it at? What location are you buying it at? Is it going to be appreciating, right? What is the rental yield? Rental yield is a concept that says that the total rent that you get over the cost of the real estate, rental yield in a place like Bombay is extremely low as compared to the mortgage or the loan that you're going to take. So keep all of that in mind. Real estate, of course, is extremely, it's not liquid, right? So don't overdo or don't go all out on real estate. Inadequate insurance. We as human beings, we have something called an optimism bias. So we don't think, we hear about people going through, terrible things, terrible tragedies striking down on them. We tend to think that those things are not going to happen to us, right? So we have this optimism bias. So most of us, I wouldn't say most of us, many of us actually are not adequately protected against health crises, against life crises. So life insurance, health insurance, extremely, extremely important. Myopic view of tax planning. Myopia is what? A short term, a very narrow view of tax planning. We save, make tax planning related investments so that we actually get a break on taxes. But by selecting the right tax investments, you can actually create a significant wealth for yourself over the long term. Right? Mutual fund ELSS is an example. If you have any questions, I'm happy to talk a little more about that. But have a broader view on tax planning. Tax planning can be used not only to save on taxes, but also to create significant wealth in the long term for you. Investments done in an ad hoc manner. We already looked at that. No documented financial plan. If you don't have a financial plan that is documented, you don't know what your investment strategy is. You don't know what you're going to adhere to. Right? So it's extremely important. Lack of goal setting and planning, which is actually brings us to the topic at hand, right? So now let's look at in the context of what we've seen so far, that how decisions should not be made. Now let's look at how decisions should be made, or what should drive our investment decisions, right? The most important thing is our financial goals, our dreams, our aspirations. What is a financial goal? It can be anything. Let's say a 25-year-old, he or she wants to take a trip to Paris. That is your financial goal. It's a short-term financial goal. That should drive your investment decisions. Someone in his or her 40s who've got kids, sponsoring their child's higher education, that is a financial goal. Taking care of their retirement, right? So that you can live the retired life on your own terms. That is a financial goal. Your investments decision should be driven by your goals, not by any random index, any random product, any random return. No, think about your goals. Focus on what you can control. There are too many things when it comes to the world of investing, right? People focus on the wrong things. People focus on the returns that the stock market is going to give. People focus on the product and the returns that the product is going to give. The returns of the stock market, the returns of a specific mutual fund or a product is not in your control. There is no point in focusing on. What you can focus on is your goals, because you can truly control them, right? Extremely important. Focus on what you can control and manage your investments. The approach that I'm going to lay out, if you follow the goal-based investing approach, all these other things that surround us, the noise of returns and products and stocks and IPOs, that is of secondary importance. And I'm going to show it to you as to how that becomes irrelevant if you take the goal-based investing approach. Follow the right process, right? As I said again and again in this presentation, too many times people follow a product-led approach. This stock, that mutual fund. But that's the wrong starting point. The process should be, you first think about your goals, think about the plans, follow a disciplined process, and then comes product. Let me give you an analogy, right? Let's say you want to go somewhere, you want to travel someplace, and you haven't yet decided on the destination. But even then, you start talking about how I'm going to get to whatever that destination is, which you don't know. So you discussing, should I take the train? Should I fly? But you don't even know what the destination is. Sounds silly, isn't it? Looking at product before thinking about your goal is as silly as that. Right? So again, start with your goals. So that brings us to the goal-based investing, what the main topic of discussion. So let's goal-based investing 101. What is goal-based investing? In its simplest form, goal-based investing is associating your money with your goals, making your money work hard for you so that your money is achieving your goals. So it's a connection between purpose and money. This is a classic diagram that we actually share. This is the crux of our philosophy. See, money is just a means to an end, right? Why are we earning money? Or why some of you who are studying now, you will get on this journey of earning money, creating wealth. We're earning money, we are generating wealth to achieve something. It's not a blind pursuit of money. At least it should not be, in my opinion, right? And when you connect that money with your goals, then you have a goal-based investing. Why should you practice goal-based investing, right? Number one, it lays out a clear success criteria for your investments. We are not trying to beat a specific index. We are not trying to achieve a certain amount of return. We are just trying to achieve our goals. If we are able to achieve our goals, we are successful, right? Ensures appropriate asset allocation. I'm going to talk a little bit about that, but asset allocation is a fancy way of saying not that you don't put all your eggs in one basket, right? So you allocate your money across different financial assets, be that in cash, FDs, stock markets, bonds, and whatever. Right? It automatically ensures appropriate asset allocation, and I'll talk to that on the next slide. It takes away the stress of chasing returns or beating the market. It's all irrelevant. Keeps you more disciplined. Think about it this way: if let's say you are in your 40s, see, and excuse me a little bit because I don't know what the target average age of the target audience is because I didn't have that information. So I'm giving all these examples. I'm hoping that it will sort of, through my examples, I'll cover the whole range of audience that we have right now. Let's say if you're in your 40s, you're setting aside some money for your child's higher education. Before you touch that money, unless you achieve that goal, before you touch that money, you're going to think 10 times because that money is associated with a purpose which is very close to your heart, right? So goal-based investing keeps you automatically disciplined. Now, there are 3 steps to sort of implementing goal-based investing in your life. Number 1, figure out why money is important to you. I've been talking about it, right? We've got all these goals. People talk about all these. I want to buy my home. I want to set aside some money to take care of life's emergencies, higher education, buying a car, and whatnot, right? But when you start peeling the onion with investor, when you start probing deeper, you know what emerges out of it? People want, why is money important to us? Because people want financial freedom. People want financial security. People want freedom from financial worries, right? That is why we all are earning money. And eventually we all are earning money to be happy, whatever happiness that money can bring to us, right? I've had so many conversations with investors. Not a single investor has come to me and told me that, look, I don't care about being happy. I just want a 20% return from the market. No one has done that. I don't anticipate anyone doing that, right? So be clear why money is important to you. Get clarity on your goals. Now, 4 questions I would want our investors to think through, right? So how much money do you need to achieve your goals? You've got all these goals. Get clarity as to how much money you're going to need to achieve those goals, right? Over what time period? There are certain goals that are immediate goals, up to 1 year. There are certain goals that are short-term goals, right? 2 to 4 years. Certain goals are long-term. Depending on the duration of the goal, your asset allocation will be determined, right? For some of the short-term goals, there is no point in you investing your money in equity markets because of the zigzag of the market, because of volatility, right? For the long-term goals, you've got enough time horizon, you can access the equity markets, right? So this is the point that I had made on the earlier slide, that your goals decide your asset allocation. Think about what your top priority goals are. You may have 10 different goals, but the money is limited. So prioritize on those goals. Go after the top goals. And then figure out how much money should you invest to achieve your goals. I'm going to give you an example. As I said, I've taken an example of retirement. I hope, look, maybe many of you are in your early 20s. Retirement may not resonate with you, right? But it's never early to start thinking about retirement. And for someone who is in his 20s or early 30s, I'll give you a different context on retirement. Retirement is nothing where you can think about retirement as a wealth creation goal. You just start creating wealth in your 20s, in your 30s. It will make a lot of difference. And you can use that money for whatever you need to, right? So it doesn't matter whether retirement is a specific goal that you have. Start setting aside some money. But I've taken an example of a retirement. So the question is, do you know how much money you need to enjoy a comfortable retired life, right? Most people are not able to answer this question. So there is a lot of data on this table, and I'm going to walk you through in a systematic manner. So I've taken some scenarios over here. So the first column is your current age and what age you are. The second column is your retirement age. And third column is your monthly need on retirement, right? How much money you will need when you retire without inflation and with inflation. And then if that is your monthly need, then how much corpus you're going to need, and then required monthly investment. So let me walk you through the first line, right? If assume that, let's say your current age is 30, you want to retire at the age of 60. And you're telling yourself that, look, in today's rupees, without considering the inflation, I'm going to be happy if I am going to be able to earn 50,000 rupees per month. That's going to take care of my needs when I retire, right? Now, 50,000 in today's terms is about 2.9 lakhs when you retire at the age of 60. This is where the inflation comes in the picture. So you have to be very careful. Okay. So then at the age of 60, your monthly need is going to translate from 50,000 to 2.9 lakhs. Keeping that need in mind, how much money you're going to need from age of 60 to 85? Let's say assuming a lifespan of 25 years. We all are living longer, right? So we need to actually take care of that much lifespan. You will need about close to a little more than 6 crores of a corpus. And in order to get there, you can actually easily get there if you start investing monthly about 80,000 rupees. So this is the example. Remember what I talked about right at the beginning, the difference between reality and perception. Most people underestimate how much money they need to actually safeguard their interest in retirement. So this is just an example. If you're 35, 60, this is the corpus that you're going to need, about 4.7 crores. See, keep one thing in mind. As you start going down the table, if you look at the last column, the amount that you need to start saving and investing goes on increasing. Why? Because you've got a shorter period of time at your hand. A person who's at the age of 30 has got 30 years to take care of his or her retirement. Person who's 50 has got only 10 years. Assuming that, of course, I'm assuming that most people in their 50s have thought about retirement. They've already got some corpus, right? But the key message over here is that this is the clarity that you should get on every single goal that you have, right? And start early. There is a power in starting early. Step number 3, choose your asset allocation wisely. These are just a sample assets that I've put on the table. I'm not going to go into the details of every single asset, what is good, what is not good. It all depends on 2 things. So the question is, what should drive your asset allocation? Number 1, your goals. I've been talking about it. Number 2, your risk appetite. So what is our risk appetite? So let's look into the risk appetite. Now, before you think about risk appetite, you need to understand the different flavors of risk. Too many times I've seen investors making a mistake in risks. Most investors think about risk in this way. So on the left-hand side, there are the least risky assets. And on the right-hand side, there are the most risky assets. Cash. Most investors think about cash is the least risky option. Why? Because we know we put some money in our bank account, 1 lakh, 2 lakh. We know tomorrow we wake up, we check our bank account, it's going to be there, right? Provided we all trust our banking institutions. We wake up in about a year's time, we know that that money is going to be there, right? So people think cash is the least risky option. And as you start moving towards your right, I would want to point your attention to, let's say, number 7, global equities. When people hear about equities, people immediately have this visceral reaction. Equities, oh no, stock market, extremely risky. I want to stay away from it, right? And as they start moving up, all of these so-called risky assets, they start plugging in that sort of risk spectrum. Most people think about risk like this. This is the wrong way of thinking about risk. This is called the uninformed risk. What is the informed way of thinking about risk? What is the right way of thinking about risk? First of all, you have to bucket your risk into three broad buckets: volatility, inflation, and loss of capital. What we associate with stock market, and when we say stock market is too risky, more often than not, we are thinking about the volatility. We're thinking about the ups and downs of the stock market. And we conclude that that is going to make us lose our money, right? So that you have to be very clear about the risk. And if I now plot all these 10 items on this new scale that we have and the new buckets, this is how they plot. Can you spot where cash is in the scheme of risky assets? It's number 7. You know why I've put cash over there? Because cash has a significant risk of inflation, which we don't think of. We all have seen in our lifetime prices going up, right? The money that you put in your bank account, in your savings account, without doing anything with it, that money is eroding every single day because of inflation. And keep in mind, we are now in a low interest rate regime. All over the world, the interest rates are at its lowest. If you think about India and the interest that you're getting on FD, it's about close to 4% average. What is the inflation in India right now? 5%. By keeping your money in FD, you are potentially going to lose your money. But you don't even realize because you see that money that staying there, right? But inflation is a big risk. That's why I put cash as number 7. Now think about global equities. I'm just going to take these 2 examples because we want to talk about stock market, right? Global equities, great companies, is actually the least riskiest option, provided you invest money in a systematic manner. That's why it's number 1. Risk of volatility doesn't mean risk of capital loss. Doesn't mean you're going to lose your money, right? But then on the other hand, as you start moving up on this new scale towards the right, when people are thinking about investing in a single stock, specific IPO, extremely risky, right? So that is towards the right hand spectrum of the risk. This is an extremely important concept of understand the risk from this lens. Don't be afraid of the stock market. You can manage that risk. A classic quote from Warren Buffett again: risk is not knowing, excuse me. Risk is not knowing what you're doing, right? That is the biggest risk. So now we're going to conclude this with principles of, let me do a time check, principles of wealth creation. I'll take another 5 minutes and wrap it up. And before that, before we jump on the principles, now let's talk about the market. Everyone's been talking about the market, right? What you see on the screen is a journey of BSE Sensex from 1980, when the Sensex came into being, till 2020, right? Or 21, 40 years, roughly 40 years period. And there are all these events that have been plotted on this slide. Different international events such as the 2000 dot-com bubble burst, 2008 financial crisis, plus various political events and so on. And the market has responded to all these events, right, with ups and downs and so on. The 2 things that I want you to actually take away from this slide, 2 very important things. Number 1, the stock market movement is never a straight line with an upward slope. Right? It is always a zigzag. And you have to accept that this is called volatility. If you look at any stock market, let's say the US market, which is far more robust, far more mature, is 17 times the size of the Indian stock market. If you look at the proxies for the US market, S&P 500, NASDAQ, they all show this similar curve, similar trend. It's a zigzag, but over time it has gone up, right? So stock market is never a straight line journey. That's number 1. Number 2, where it was in 1980 and where it is right now, there is a day and night difference. Right now, we're looking at Sensex has already crossed 50,000. It has now come down. It's 50,000, 49,000. Nifty has already crossed 15,000. Right now, it has come down 14,000. It has over the long term gone up. We see the similar trend across all global markets, right? In fact, I read somewhere that if you had invested 1 lakh in BSE Sensex at the beginning of the stock market, 1980, that money would have been 4 crores if you had not touched that money, right? That is the power of the stock market. You want to be in it for the long term. But if you let these ups and downs drive your decisions, remember the timing the market that I talked about as the wrong behavior. When the market goes up, you put in. When the market goes down, you pull the money out. You're not going to get benefit from this movement of the stock market. That is the gist of the stock market. Be in it in a systematic manner for the long term, and you may be able to create a significant wealth from it, right? So that brings me to the last topic, principles of wealth creation. Number one, always let your goals and your risk appetite drive your investment decisions. Everything else is secondary. Products, stocks, specific mutual funds, specific stock, it's all secondary. Returns, your goals and your risk appetite. That should drive your investment decisions. Don't be afraid of the stock market volatility, right? Volatility is a part of life of the market. Equity markets are a great way to participate in India's growth story. What is India's growth story? We've all been keeping the politics aside, right? Whether it's going to be a 5 trillion economy, whether it's going to be 3 trillion, let's keep all of that aside. It is highly likely, given where we are a developing country, right? It is highly likely that over the next few decades, the Indian economy is going to grow, despite of all these short-term setbacks, coronavirus and all that. The IMF is already projecting the economy to grow at 11% next year, right? RBI is projecting at 10% next year. Excluding, despite of all the short-term sort of setbacks, Indian economy is going to grow. There is no other way to go. And the great way to participate in this growth story and then benefiting from it is through participating in the equity markets, right? In a systematic manner. Plan on being in the market for the long term. Harness the power of compounding. Everyone talks about Warren Buffett. Warren Buffett's net worth is 100 billion. Bill Gates and all that. We keep hearing about it. I don't know how many of you know that out of the 100 billion or 90 billion that Warren Buffett has, 90 odd % of that wealth was created after his 60th birthday. He's in the market for the long term. And this is where the power of compounding comes in the effect. It is magic. So let your money be there. Don't get in the way of compounding, right? Let it grow over the long term. Do not try to time the market. You will lose. No one is going to be able to exactly know where the market is going to be 3 months from now, 6 months from now. No one's going to be able to predict it. If someone's coming to you, so-called experts, and predicting and telling you this is where the market is going to be, ignore them. No one has been able to do it in a systematic, in a consistent manner. There are all these banks all over the world, the top class institutions. They've got teams of PhDs, data scientists. Even they haven't been able to do it consistently. Right? That's why most businesses lose money when the market goes down, because they can't predict it. Do not even try to get into that. Do not try to time the market. Be in it for the long term. If you try to time the market, you will lose. The last point, meditate. As some of you know, I am also an art of living instructor. And I've been doing breathing, breath exercising, and meditation for the last 10 odd years. And saying that it has changed my life is an understatement. Why is meditation important when it comes to principles of wealth creation, when it comes to the market? Meditation lets you manage your mind effectively. Everything finally comes down to your emotions. If you're able to manage your emotions, if you're able to stick to your long-term plan by keeping your emotions in control, what are those emotions? Fear, greed. You will create significant wealth, right? So it's extremely important to learn to manage our mind effectively. Meditation is a great way of doing it. So with that, I'm going to end the session. Let me stop sharing and let's actually open it up for question and answer. So just feel free to, if you have, you can type your questions in the chat screen or you can ask them out. My only request is let's stay away from asking questions about specific stocks, specific mutual funds. I won't be able to go into those details because that is in contradictory to what I've been talking about so far. So ask me questions about sort of the process, goal-based investing. If you have those specific questions, I'm happy to take them offline, right? Reach out to me separately. Let me see if there is anything in the chat. Okay, nothing yet. Oh, I think there was something. Is there anything in the chat?
So Girish, this is Parag.
Hi, Parag.
Yeah,
How are
good
you?
morning.
Good morning.
I'm good. Yeah. So Girish, which market is good? Maybe, let me ask you. Is it European market is good to invest, or maybe Indian market is good to invest?
Indian market is great to invest right now. So is the US market. So are some of the global markets. But Indian market is great. But again, Parag, I'll take you back to your goals, right? Think about it in terms of your financial goals, because there are a lot of markets that can help you achieve that goals, right? So at what kind of risk you're willing to take, right? So I would say all markets are great. I would say as long as you're investing in a systematic manner for the long term.
Okay, thanks.
Girish, under the chat, Yash is requesting to show the last slide once again.
Okay, let me bring that up. Can you all see it?
Yes.
Yes.
Okay, you're still able to see it, right?
Yes, Girish, we can see
Okay,
that.
wonderful, wonderful. Any other questions? Anyone from the 95 batch, by the way, over here on this call? Doesn't matter.
Girish, there is one more question under the chat option.
Hey
If you can
Girish,
see.
Yes,
can you hear me?
yes.
Hey, hi Girish, this is Joseph here, Joseph Diaz.
Hi, Joseph Dias. Hi, how are you?
Hey, hi, yeah, it was really nice hearing from you after 25 years.
I know, I know. Excellent, excellent.
Yeah,
Turn
this
on
was
your
a
video.
really
If you
yeah,
can turn on your video, let me see your face.
sure. But
Joseph is my
can you see me?
95 electronic. Yeah. Nice to see you, man.
Yeah, man. Yeah, yeah,
Okay.
I just wanted to say hi to you. So that's the
Of
reason
course.
I just. But
Excellent.
we'll,
Thank you.
yeah, I'll talk to you later. Maybe.
Of course.
Okay,
Of course. Bye.
okay, okay, bye.
Bye.
Take care. Yeah.
Durlabh, what was the question in the chat? You're on mute.
I'm sorry.
So there is a question by Jyotish. I'll read it. Being in 20s, taken the fact we can take risks, should we invest in bitcoins? Asking, cause India being against cryptocurrency.
Yeah, yeah. So there is a lot of confusion in the Indian context. We keep hearing different things. At one point, the government said that they're going to ban all cryptocurrencies, and the RBI is going to float its own currency, digital currency. Now there is some other sort of signals they're giving that they're open to cryptocurrency and so on. So look, I think you have to be very careful, and I will keep taking you back to your goals. I will constantly continue to do that, right? Now, cryptocurrency is something that it's still evolving. Right now, it is crossed. Actually, the total market value of the cryptocurrency has crossed $1 trillion. It is on a roll. My suggestion is, see, look, you can don't use that as your investment strategy. But if you've already taken care of all your goals, short term and long terms, or you're on track to be able to take care of your goals, set aside certain money so that you can invest in cryptocurrency. But give yourself some limit. Like, okay, I want to test it out. Then that's okay. But that can't be your investing strategy.
So I have one question. So considering the pandemic situation, should I invest my money for long periods of time?
Yes, absolutely. Provided, remember the prerequisites of investing that I talked about on the very first slide, right? It is never too early to actually start investing for the long term, because if you start early, then you get the benefit of the compounding, significant benefit of the compounding. But you
Yes.
can invest only when you are able to take care of your short term. Now, what is it? If you're able to manage your expenses appropriately, if you're able to manage your loan appropriately, if you set aside certain emergency savings for yourself, as long as you've taken care of your short term, please, pandemic or no pandemic, the markets are here to stay. Please invest, but invest the right way. I'm not advising you to invest in a specific stock or an IPO, right? I mean, I advising you to invest in a systematic manner.
Yes. So there's one more question by Vinay. How to start investing in 20s? Are small case good options?
And should I assume it's instead of small case, you mean small cap? Okay. So again, small cap, mid cap, large cap. Small cap is what? Small companies, right? It's by their nature, they're more risky as compared to the large cap companies, some of like the Reliances and Tatas of the world. Um, there is nothing wrong as long as you're clear about the risk that you're taking, right? Small cap companies, by their very nature, they are actually prone to these volatility and the swings. So as long as you're crystal clear about sort of the risks that you're taking, and as long as that's just a part of your portfolio, not your entire portfolio, it's fine.
So Girish, he's asking about Small Case, which is an app by Zerodha. So he was
Oh,
asking
I
about
see.
that.
I see. Look, there are lots of apps, right? Zerodha, there is Happiness Factory. We have our own app. There is Grow. There is this thing. It's all fine. I mean, they'll let you invest your money. If you're in your 20s, if you want to sort of experiment, if you want to get started, please go and do that. Allocate certain amount of money. Learn the art of investing, right? But that can't be your strategy. Investing through an app can't be your strategy. In my opinion, you at certain point you need a real advisor when you're thinking about serious decisions. That's just my opinion.
So there's one more question by Manbir. Within a certain asset class, example large cap funds, what are the principles by which I can narrow down on the right fund to invest in? And what are the key metrics to look at?
Yeah, that's a great question. So if you let's talk about the world of mutual funds, right? So there are lots of large cap mutual funds by various mutual fund companies, and see the platforms such as Morningstar, for example, or Value Research, or what is the other one? Let me just Money Control, for example. They'll let you compare all these mutual funds. So what are the few things that you should be looking at? Number one, what is the risk profile of that mutual fund? What is the performance of the mutual fund? What sort of expense ratio that mutual fund has? Because expense ratio is something that you have to pay from your investments, right? So how expensive that mutual fund is. The company, assess the company, right? So there are all these various factors that you can look at. And there are going to be tons and tons of these mutual funds, large cap mutual funds and all that. So you have to be very careful. I would say, rather than, if you have the time and energy to spend a lot of time in looking at all these different variables on all these platforms and then come up with a conclusion, then go ahead, go for it. But other than that, use some of these applications that are out there, provided you trust them, that actually can compare mutual funds and serve up the mutual funds, only those mutual funds that are relevant for you. So I'll give you an example of Happiness Factory. We have all our mutual funds that we actually share with our investors have been around for at least 10 plus years, right? They're from these top-notch mutual fund companies. We look at the mutual fund performance, we look at the expense ratio, we already have an algorithm that looks at all these things. So you can download our app, HF Invest, from the App Store or the Play Store, and can play around with it, right? Whether or not you invest money through us, that's secondary. I don't care about that, but it will give you a flavor for the products and the right mutual funds. So try doing that.
Girish, this is Parag again. Which is the best forecasting model do you feel, for especially for stock market?
Best forecasting model.
Yeah.
So first of all, I'm against. See, typically what happens in the industry is that people look at the historical stock returns and then they forecast those returns, right, over the future. History is not often a good guide for the future performance. So that is a caveat that we need to keep in mind. Lots of simulation, Monte Carlo simulation, and lots of tools that will actually let you do that. But Parag, all of that is of secondary importance, in my opinion. If you are investing in the market for the long term, you don't need to go into this, because if you look at the history of the market, let's say 1980, I have the over from 1980 to 2020, I've got the historical returns by the stock market over 20 years windows, 10-year windows. As the time in the stock market increases, you will, at least that's what the history says, you will get double digit returns. The volatility reduces, right? So as long as you're in the market for the long term, you don't need to worry so much about the forecasting and all of these things come in the picture if you're playing a short term game, which is extremely risky. No forecasting model has been able to predict the market movement in the short term consistently and reliably.
There is one site called simply wall.st,
Hmm.
and it is giving a lot of good analysis about various companies. And I
Okay.
feel this is really good to see from all the different angles, so they give that rating and everything.
Got it. Got it. There are
Yeah,
lots
so
of
can
such
you
websites.
suggest something, like this kind of maybe
Yeah.
it will be
Go
good
to
input for everyone.
go to Money Control, Morningstar,
Mm.
Value Research.
Okay.
Go to Wall Street Journal. Lot of websites.
Thank you, Girish.
So there's one more question by Lokesh. Index funds are specific mutual funds for long-term investment. By specific mutual funds, I mean like technology, private bank, PSUs, etc. Or should we just go for index funds as their expense ratio and exit load are very less?
Yeah, actually, that's a great question. See, I typically try to stay away from sector-specific funds. There's nothing wrong. Like technology, pharma, they have done well now, right, in the last year or so. But pharma was not doing that well. So I typically stay away from it if you are playing the long-term game. Index fund is a great way to do it. I'll just give you one thing. If you were thinking about, if let's say we were in the US market, I would have, without any hesitation, told you go for an index fund, because the US market is far more mature as compared to the Indian market, right? It's far more robust, and it's extremely difficult to beat the US market. So index fund is a great way to do it because the costs are at its lowest. Indian market is not yet there, in my opinion, right? So there is a possibility of some of the mutual funds being able to give you a better alpha for your money than better than an index fund, right? So keep that in mind. But again, starting point should not be whether I should go into a sectoral fund or I should go into an index fund. That should not be the starting point. The starting point should be, why am I investing? That is the starting point. Ask that question to yourself. Be clear about that. Is it a long-term play? Is it a short-term play? Then the product answer will follow that, not the other way around.
So there's one more question by Amit.
Yeah.
How can we invest in USA market from India?
Yeah. There are a lot of mutual fund companies that actually allow you to do that. So they've created funds, and Durlab, you may know some of the names that actually give you exposure to the US market, gives you exposure to NASDAQ and so on. Durlab, do you know of some of those funds that in the Indian mutual fund companies have for the US market?
Yes, so there are a lot of mutual funds which allow us to invest into US funds. So like similarly, we have blue chip funds which invest into an Indian market. There are US blue chip fund with different mutual funds like ICICI, HDFC, Axis, and they all of have those kind of funds. So if you have any such query, you can get in touch with us. We can discuss those fund in
Wonderful.
detail. Like
Uh, Looks like we have covered a lot of topics and doubts. I would now like to request all of you to please fill the feedback form mentioned in the chat box. It is my great pleasure to now deliver the vote of thanks concluding our event here. It was a privilege to hear Mr. Girish, and the questions asked by our audience really contributed to the webinar. For this, I would like to thank our amazing and experienced speaker, Mr. Girish, for taking the time out of your busy schedule and helping to guide our alumni community as well as students to understand the basics of financial planning and investment. The Alumni Association of FRCRC, including our dynamic faculty members and various alums who helped make this event possible. And of course, a keen and energetic audience who not only learnt a lot but also contributed to this discussion through their questions. And lastly, I would like to thank the Student Alumni Committee who put up this event. Finally, a big thank you to all of you present here, and I hope that, like me, you too have more clarity about the financial planning and can maybe start investing with a more strategic approach.
So look, first of all, I want to extend my thank you to everyone and the alumni
Yes.
community for bringing me back after a long time. As I said, this session is close to my heart. I hope this was helpful. I hope you were able to walk away with something tangible. The last point that I made, I want to make that point again because it's that important. Figure out a breathing or meditation practice for yourself, right? And I actually offered to Marina that if there is interest, I can come back for another session and actually talk about breathing and meditation. So it is that important and it is connected with our overall well-being, right? So keep that in mind. And with that, thank you